Welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, 2021 was a blockbuster year for equity investors. Sensex returned more than 20%, but this year hasn't been as fruitful so far. The markets have seen sharp corrections over the last couple of months, and the fear of recession has started mounting globally. In such a scenario, if you're wondering how to safeguard the profits that you've already made, watch today's episode.
Markets are like that only. They go up and down dramatically, and over a long period of time they go up. Other worrisome part is that it happens when you least expect it. Once you have developed a full confidence that okay, market is steadily going up, it is generating returns for you, and in a couple of days you'll see a complete turnaround. And once they are crumbling, they have gone to the basement, and then suddenly you will just be on the verge of giving hope that they will turn around, or maybe once you give up hope, they turn around. So markets will remain like this. They have historically gone up over a long period of time, and in between they have behaved like this only. It is important for investors to devise some mechanism so that they can reduce their regret, and more so in the initial years. Once you are relatively new to the market, getting used to it, it's very important to devise some mechanism. It's extremely difficult to anticipate the events. One thing is that if you can really anticipate these events, but you can't. Look at everything that has happened in the last 3-4 years. The pandemic, everybody ran and the market collapsed. This was April 2020. And looked like the world was coming to an end, and understandably and maybe rightly so, everybody was so fearful. And then everybody came back to the market while the world was in a state of standstill. Everybody started investing, and everybody started investing more as they were all sitting at home, and the whole market is now digitized. So we saw the whole resurgence, the whole revival of the market. While the economy was on a standstill, everybody stopped consuming a large number of goods and services which we are regular consumers of. The big IPOs happened, the digital IPOs, and everybody was excited about it. And then people lost money. There was a realization immediately thereafter that okay, these companies were fancied one, but they don't make profit. What a obvious realization, and bit too late. Then it was followed by the war that happened, and what could have been a very small war between a small country and a big country and a neighboring country. It has become a global event, and it has disrupted the global supply chain, and it is impacting the whole world. All these things could not have been anticipated. You could have anticipated one thing, that what kind of ups and downs you are comfortable with, and that is asset allocation. Set your asset allocation, follow it. That's the only way to reduce your regret. The other is manage your anxiety, and do it very much in line with the scale of your investment, because my sense is that it just doesn't make sense to do any think very intensely about asset allocation while you are in the initial phases of accumulating your savings. Say you started 6 months back and you started with your 5,000 rupees every month. Even if the market goes down, how does it matter? Maybe the initial months of behavior should be that don't look at the value. But after you have accumulated something, then you have to devise your asset allocation rules for yourself to manage your anxiety. There are different financial models which give you a very complex outcome, or suggest you that do this, do that, whatever. My understanding of asset allocation is that you should be substantially into equity and nominally into fixed income. That is 2/3 of your money or 3/4 of your money into equity and 1/4 of your money into fixed income. The result of this will be that if markets go down dramatically, you will have money to invest in equity. The second asset allocation is half of it in equity, half of it in debt. So, and have a liberal move. If the asset allocation changes by 10 percentage point, if your 50-50 becomes 60-40 or 40-60, then you will act. So you are not going to do it every day, every week or every month, but a big shift, and then you get into act. The third thing is that a small part, a 1/4 of your money or a 1/3 of your money into equity, remaining in fixed income. This is meant for the conservative investor. And if whenever you see a big shift, I think the most important thing in your asset allocation is to devising the rule besides asset allocation, that when you will act, when you will make that rebalancing. Because if you do it too often, it will have a tax implication, and then you will have to be in a state of alert all the time. If you keep it too late, then you will miss all the opportunities. So what is the kind of, can you set up an alert when your asset allocation actually goes out of whack by 10 percentage point? Yes, you can, and you can well do it in an automated way. You can do it on Value Research Online's portfolio manager, and whenever changes in that, and you will get an alert. So don't work too much on this, but on key occasions do act. The asset allocation model which I explained sounds simple, that a third of your money in fixed income, half of it in fixed income, or a third of your money in equity, remaining in fixed income. So, but it's it sounds simple, but it is difficult to do. Psychologically, it is difficult because it amounts to taking a contrarian action. When your equity values are going down, taking money out from fixed income and investing in that, and the market goes down even further thereafter. So it's a very difficult thing to do. Likewise, on the other side, when your equity values are going up and it goes up from 75% to 80% to 85%, and then you take your profits, move it to fixed income, reset your allocation, which means you are selling your winners and putting money in the losers. So it's many a times it translates into a short-term regret. And the other problem is that you have to be on your toes, and you have to act. And most people tend to get very passive with their long-term investment, and they want to be passive with their investment. Third is that most people don't do it, simply sheer inertia. You invest and then you forget, and you don't want to act, and you don't want to be mentally involved with that intensely. So with this in mind, I would suggest that there is a simpler way of doing it, and it can be done in two phases. One is that invest in an aggressive hybrid fund. You won't have to do anything. You put your a lakh of rupees, and 65 or 75% of your money is into equity, 25% into fixed income, and that is it. Whenever it goes out of whack, the fund manager does it. You don't worry about it, and he takes a ride of 5-10% and then rebalances it. Look for a fund which is proactively good in rebalancing. Choose a fund which is disciplined and does the rebalancing regularly, and that will come to your advantage. One is that they are less disappointing in a crumbling market. The other is that many of these market phases, when they tend to do much better than many of the all equity fund, a fully invested equity fund, some of these funds actually do well just by proactively rebalancing. So this is one. The other thing which will save you from great deal of anxiety is that simply don't invest the money that you need in next 2 to 3 years or 4 years. Don't invest in equity at all. Your asset allocation is happening in a very more customized manner. The money that you need in next 3-4 years should be invested in fixed income. That will not be dependent on the state of the market. Even if it's a disappointing return, it will tend to be positive return. Investors have a very different behavior, very different reaction. When they lose money as compared to earning less, you are not as disappointed if you earn 4% return while potentially you could have earned 10%. But your 100 rupee becoming 95 is greatly disappointing. It creates great deal of regret. So put your money in fixed income and invest in these asset allocation funds which are proactively doing the asset allocation for you. You can remain in the state of inertia, and that is a good state for most investors to be in. That is how investors like, and that will get you the benefit without the work.
Well, with that, it's a wrap. Keep watching this space for more information, and if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.